Hi, this is Mike Yan. I'm a client portfolio manager here at Westwood. Today it's my pleasure to introduce our market outlook call. We've got Adrian Helfert, Chief Investment Officer for Alternative and Multi-Asset Portfolios, and Scott Bernard, Fixed Income Portfolio Manager. They are going to discuss what we are seeing in capital markets and some trends that we are watching. They'll discuss the role of inflation, expectations on upcoming Fed action, and the implications they see as a result. Scott, Adrian, good afternoon.
Good afternoon. Thank you for having us.
Thank you.
Yeah. So we'll start out, Scott. So inflation reports have been stickier than expected in 2024. How do you expect the Fed to react in respect to these interest rates?
Yeah, certainly. So, as you noted, 2023 we had a lot of momentum with inflation going down, and the Fed pivot, as everyone was calling it, around October, September of last year, where they started talking about upcoming rate cuts, drove market performance in the fourth quarter of 2023. We've seen a lot of that reverse course in 2024, as inflation has in some ways reaccelerated, depending on which metric you're looking at. CPI has certainly reaccelerated. The Fed prefers the PCE metric. PCE continues to decline, but at a lower rate than the Fed had hoped. As a result, just recently, last week, Jerome Powell gave a speech where his tone had started to shift. He now was talking about how inflation had not come down as quickly as they had hoped, and was saying that it's quite likely that any rate cuts will be delayed until later in 2024, or that they potentially could keep the Fed funds rate unchanged for quite some time. I think ultimately they will remain data dependent. And, we just will have to watch inflation. We'll have PCE at the end of this week, which will give us a fresh number there. And ultimately, I think where the market is pricing now for 1 to 2 cuts in 2024 is fairly reasonable. But we also have the election upcoming, so things will get a little volatile towards the end of the year.
Yeah, and I'll add to that let's just go back to the sticky inflation commentary and what sticky inflation means. It's kind of an expectational term. It is what the expectation for future inflation is in consumers' minds. Historically, prior to about 2019, the average expectation for inflation, meaning how much you expected prices to rise in the future over the next year, was about 2.5%. Right now, we are pretty volatile on that term, but running around 3%. The Fed needs to bring that part down. They need to bring the expectation that inflation is going to rise in consumers' minds, and subsequently then in companies' minds that they are going to raise prices on their goods in order for that to happen. And of course, unemployment being low, you can walk across the street and get a job, which means consumer confidence is still reasonably high, is a hard environment to bring inflation down. At the same time, it's a good environment for the Fed to have the ability to keep rates at an elevated level and have consumption still supportive of the economy. So we're actually in a decent spot of, it's good that we have good consumption. It's good that we have low unemployment at the same time that we have this inflation, because it gives the Fed the capability of controlling inflation with less concern on a significant downturn to the economy at the same time.
Great. Thank you, guys. And so if we look at that and we're looking at these Fed reactions, how does that affect my portfolio, and how are you positioning? Given that rates will be cut not as much as we had thought, why would I not just sit in cash if rates are going to be higher for longer?
Right. The biggest reason not to just simply sit in cash is the uncertainty. And what if we're wrong? What if something happens in the economy and the Fed does start to cut rates more aggressively than people expect? As we saw in late part of 2023, when the market expectations start to turn, you'll see bond yields decline not only on the front end, but also further out. So 5-year, 10-year, 30-year bond yields also decline. So the reason not to solely sit in cash now is, the reinvestment risk on what if you're in 1 month or 3 month T-bills and those mature in 1 month and it's a different yield environment, you're exposed to what the rates are at that time. So what we often recommend for clients is to put in some sort of a bond ladder. You can go to various terms of duration or maximum maturities, but protecting yourself some from changes in future bond yields by locking in some of these yields for longer time periods and what we deem to be relatively attractive yields.
Yep, that's a great point from Scott. I'll add to that as well that we heard the same narrative last year of cash returned 5.1% and was yielding good. Why not just be in cash? Large cap equities returned 26%. Cash was the worst performing asset class. So clients should think about their asset mix relative to how other things can perform. We just talked about on the prior question how consumption is still reasonably supportive of the Fed being able to manage the economy, that unemployment is low, that consumer sentiment is reasonably strong. In that environment, we could still see a strong response from equities and corporate bonds that could reduce their spreads in other areas that investors can find the capability of earning risk. One element of that as well is if inflation remains elevated at the same time, which of course it's elevated now, you want something that's inflation protective. And cash will hold ground, it'll give you a yield, but inflation protection oftentimes is things like equities, where equities are rising prices. As we just talked about, that expectation of rising prices, companies are doing the same thing. And as they're rising prices, they're gaining more earnings. And as their earnings are going up, even if the multiple remains the same, the amount you pay per unit of earning remains the same, the price goes up. That's an inflation protection to some sense of owning equities in an inflationary environment or owning risk. So investors sitting just in cash, waiting for something to happen is very rarely going to be the path that is the most beneficial to them. Oftentimes they need to look for, kind of like Scott was talking about, laddering of risk in different areas and bonds. Same thing across the asset space of looking for areas for investment that protects their portfolio and gives them upside in the long term, just like we saw last year.
Great, thank you. So following up on that, Adrian, so we're talking about, we've had a lot of clients talk about different asset classes, traditional bonds and equities. What strategies outside of those traditional asset classes have you been using in our investment portfolio to kind of help diversify, dampen volatility, and help with some of that inflation risk?
Sure. Well, we think about traditional asset classes. We think about stocks and bonds. Those would be the traditional of what you go into. We are looking at subsets of those where we're actively considering how we rotate among the sectors, and we're looking at real estate investment trusts when they become attractive. And we see new home building pick up, and we start to see home builders that are doing well. We can allocate capital. So that's attractive areas that we're finding for quick rotation. In a multi-asset strategy, that is one of the areas that benefits investors, of finding that decorrelation of rapidity in the ability to rotate around asset classes. I think of when you squeeze the bubble, where does the air come out? You want to chase valuations where they exist. We're able to take advantage of that in sector rotation, in asset classes, and asset classes that aren't just thinking about pure bonds. It's thinking about where on the maturity spectrum you're going to be allocated, just like Scott spoke about, and allocating then into different quality spectrums of corporate bonds. So at times holding those high yield bonds that are going to get upgraded, or finding secured versus unsecured bonds in the corporate bond space. In the equity land, of course, we're looking at master limited partnerships, infrastructure, and infrastructure is a key area as well that provides investors with great income and is sensitive to elevated inflation in a way that can protect investors from inflation. So you think about multi-asset space and the ability to allocate capital across common equity, real estate investment trust, master limited partnerships, using preferreds, which is a portion of the company's capital structure that can provide great income. When we see rates drop, which they will, those are going to perform very well and hold their value for investors. And then in corporate bond space, allocating capital across U.S. Treasuries in different maturity spectrums and profiles, and corporate bonds where we find the ability for companies to become less risky and thus the corporate bond to appreciate.
Great, thank you. Just following up with that, Adrian, we've had a lot of questions, just given the year that it's been. Two kind of subjects we want to touch on is one, the tensions in the Middle East. How is that affecting our portfolios? And then two, it is an election year. We have heard concerns about the amount of debt the U.S. is carrying. What are your thoughts on that? And is this something that we should be concerned about?
Sure. Well, the first one is easier, funnily enough, than anything that involves the election year. The election year is, I'll take that one separately. On what's happening in the Middle East, the first thing you think about when you think about conflict in the Middle East is the Suez Canal. About 10% of the world's oil supply comes through the Suez Canal. And of course, when something happens there, we worry about the constriction of the supply lines and oil prices to rise. We've seen that in oil prices already, of rising as a result of this geopolitical risk and the potential for either further sanctions or for just general blockades in other areas that may happen as a result of hostilities to decrease supply at the same time we have demand. That can then subsequently lead to inflation. And that's energy inflation, so it's not core inflation, but it hits your pocketbook. If you're cleaning houses and driving to each of your individual houses, having a higher gas cost is certainly an inflation that hits your pocketbook. So this is something that can wash up on U.S. shores, even as it results from Middle Eastern hostilities. The other stuff that happens as a result of the Middle East usually is just the uncertainty, the unknown, and then the hit on consumer confidence. What does it mean if we have increasing hostilities in the Middle East that may result in a widening of the conflict? We don't know much, other than defense spending probably increases, and so your defense sector does well as a result. We know that it probably increases the concern that we might have a trouble in U.S. markets or a lack of confidence because consumption may decrease as a result, and it's uncertain why. But those things actually lead to a potential vicious cycle. When you have dramatic decrease in consumer spending as a result of confidence dropping, then a vicious cycle can result. Thus, it increases the risk premium. So, long story short, we worry about the energy prices increasing and the result that has. Number two, we worry about the impact on consumer confidence, and then the stoppage in the consumer spending that is really supporting the U.S. economy.
I would just add, the counter thing that can happen in these times where you have these escalated tensions is a flight to quality bid, and you can often see, despite the longer term potential impacts from inflation, the immediate reaction from investors is sell equities, buy bonds, and we did see some of that happening, somewhat brief periods, but you do still see that happening. So it is another reason to have some bond exposure in your portfolio to something that's going to perform well in those big risk off days.
Agreed. Your second question, Mike, was around really around the debt load and coming into an election year, without addressing the election year because it's kind of still who knows what's going to happen. On the debt load where we are, it's definitely at an elevated level relative to history. It's not at Japan's level, which is around 250% of their debt to GDP. Ours is over 100%, but that's still an elevated level. Countries get into trouble when their debt load is not in their own currency and is owned by foreigners. Our debt load is in US dollars, both at home and abroad. That's helpful. We do generally want our debt load, or our debt relative to our gross domestic product or our economy, to go sideways as a budget constraint. Otherwise, interest costs start to consume the budget. That's the concern, is that interest costs become so elevated that they take up our budget. And when government debt gets to be about the size of the US economy, the danger zone would then be where, of course, the interest rate that we're paying significantly exceeds the economic growth rate. At that time, we have a runaway spiral in place. We're not there at current. We have our control of our printing press, for better or worse, and the interest load is not so much that it's consuming our budget deficit, our budget, but our deficits are rising. and increasing, and is something we're certainly monitoring. We are still a global reserve currency, so this is something that we'll be mindful of if other countries start to expand out or diversify their treasury holdings and their currency holdings, because that could change, but that's a longer term. We don't think that clients should focus on our debt load so much as other policy implications of the election itself, but it's something we'll be mindful of. At the same time, as Scott just mentioned, a safe haven in time of things like conflict in the Middle East is still going to be the United States and our US treasuries. If we lose control of that global reserve status, or we start to see an elevated debt load give a lack of confidence of investors that we can actually support that debt load, then we could see that change. But that's not a near term, that's a medium to a longer term dynamic.
Great. Thanks, Adrian. And just a reminder to everybody, we are having Dan Clifton from Strategis come speak to us about the election and the outcomes. He's a political strategist for investments, and that will be later on this year. Everybody will get a invitation as we draw nearer. Scott, question for you. So treasuries are pretty attractive with most of the yield curve at about 5% or higher. Can you touch on, the spread sectors within fixed income and what other opportunities there are in fixed income outside of just the, traditional treasuries?
Right. Yep. Certainly. So the three main sectors that we look at within the fixed income market for most of our clients are, treasuries, as you mentioned, corporate bonds, and municipal bonds. So when looking at relative valuations between those, you're often looking at what we call bond spreads or yield differentials. So in times like now, with equities, near all-time highs, it's perhaps maybe not surprising to hear that bond spreads are quite low. Now, a low bond spread means that you're not earning much additional yield for taking on default risk by buying an individual corporate bond. So in the current environment, treasuries, as you say, are reasonably attractive. Corporate bonds are not as attractive as they have been in prior periods. So when we look at that spread you're earning right now is in the 16th percentile when measured against history. So meaning only 16% of the time has it been lower than it is right now. Typically, you earn a little bit more for taking on that default risk. Now, that said, there are still opportunities, and for a buy and hold investor looking at an investment grade company with strong underlying fundamentals, you're likely going to earn that excess yield. It's just that you're not earning as much relative to treasuries as you have in the past. The other sector that we look at is municipal bonds. Municipal bonds are also trading relatively tight compared to treasuries. Given the tax status, they trade at a lower yield than treasuries, but you look at what's known as the treasury ratio. So in general, right now, municipal bond is trading at about 68-70% of a US treasury bond. So once you take into account the federal tax exemption, you're earning a tax equivalent yield in municipals that's modestly higher than treasuries, but not as much as you have in the past as well. So we think for clients, it makes sense to hold some more treasuries now than perhaps they have in periods when risk spreads are higher. And you can always sell a bond and move into something else. So if we do enter a time of stress and your treasuries or your holding have probably increased in value, it's possible that the corporate bonds out there, the municipal bonds out there have decreased in value or not increased as much. And there'd be opportunities to make rotations within your portfolio at that time.
That was really well said. If anything, it is simply that, back to the Fed, often when you look at that yield spread or the spread on a corporate on aggregate or as a whole, that's credit availability in the environment, that's financial conditions of the overall environment, because credit is generally more systematic. When things go south, you see a higher default rate and you see spreads widen significantly. Right now, I'll just mention that one thing keeping spreads or that default compensation depressed is the fact that the Fed actually can control rates. In a zero interest rate environment where we came from, they could do much less of that. Now at an elevated interest rate path, if we start to see things go south or financial conditions drop significantly and companies maybe hit a near default condition, the Fed has the ability to provide stimulus to the economy by dropping interest rates, something they couldn't do in the past. That ability in and of itself of helping control the economy can actually lead to a longer term depressed systematic risk that you see reflected in a lower spread compensation. Thank you for your time.
Great. Thank you guys for the time. This is very informative. I just want to tell all clients, if you have any questions, please reach out to your advisor. We're happy to help. Bye.
Thank you.
Thank you.